In this video, we're talking about fixed versus variable interest rates. You'll learn what that means, the pros and cons, and how to decide which is right for you. And welcome back. I'm Erica. I'm a lawyer and I paid off over $200,000 of student loans, so I definitely know a thing or two about interest rates. Just to start with the basics, an interest rate is how much you're paying to borrow money. So let's say you take out federal student loans, which means that the government is loaning you money now so you can pay for your education, but it's not for free. There has to be some sort of incentive for the government to loan you the money, and that's the interest. If it loans you $10,000, then the expectation is that you'll pay the $10,000 back plus an additional amount on top of that, the interest, whether it's 3% or 5% or 10%, and you'll do this in a set amount of time. That's the term of the loan. You might have a fixed or variable interest rate for your student loans or your mortgage or auto loans, for example. Now, a fixed interest rate loan means that the interest rate remains the same throughout the life of the loan. Your monthly payment for that loan is never going to fluctuate because it's a set interest rate. You'll also know with certainty how much you'll pay in interest over the life of the loan. That's something you can calculate from the very beginning. Fixed is pretty straightforward. With a variable interest rate loan, your interest rate might fluctuate over time based on prevailing interest rates. What does that actually mean? Well, with a variable interest rate, the rates are usually pegged to changes to a well-known index, such as the 1-month LIBOR. LIBOR is the interest rate that many banks and lenders charge one another to borrow money. The 1 month means that the variable rate can change monthly. Now, if the variable rate changes, that also means that the monthly payment due for that month will change, and the total expected interest owed over the life of the loan will also change. You might hear a term called a variable loan cap, and that just means that's the maximum limit on the interest rate that you can be charged, regardless of how much the index interest rate changes. If the variable loan cap is 10%, for example, then once your variable interest rate hits 10%, even if the index interest rate increases again, your variable interest rate won't go above that 10%. So let me show you how the difference between variable and fixed actually looks with numbers, and we'll use student loans as an example. And since we're talking student loans, just to clarify, all federal student loans have fixed interest rates. So you would only have the option to choose a variable rate student loan with a private lender. For example, if you're refinancing your federal student loans with a private lender like I did, which we can talk about in a bit. Let's say you have a fixed interest rate student loan. You borrow $100,000 on a 10-year term. Today, your interest rate is 4.5%, and your monthly payment will be around $1,036.38 as long as you're making your minimum monthly payment on time and not making any prepayments. That's the same whether we're talking about today, or a year from now, or 5 years from now, or 8.5 years from now. It's going to remain the same. Now let's say you have a variable interest rate student loan. Often, if you select a variable interest rate loan, it might start off with a lower interest rate than a fixed interest rate loan, but there's a risk that the payment will increase over time. Let's say you borrow $100,000 on a 10-year term with a variable rate. If it starts at 4.1%, that means that today your interest rate is 4.1%, which means your monthly payment for this month is around $1,017.21. But a year from now, that variable rate might have increased. Let's say it increased to 4.7%, which means your monthly payment a year from now is around $1,046. So why would anyone ever choose a variable interest rate loan if there's the risk that it'll increase like that? And how do you know which is right for you? I chose a variable interest rate student loan, and I'll talk about why next. Before I do, I wanted to take a moment to thank the sponsor of this video, SoFi. I refinanced my student loans with SoFi and was able to save so much money by doing so because they were able to offer lower interest rates to me. that helped make it possible for me to get to my goal of paying off all $225,000 of my student loans in 2 years. If you have student loans and want to know how much you could be overpaying, I'll leave the link to the student loan refinancing calculator that I used, and you'll be able to calculate your estimated savings by refinancing with SoFi. So thank you very much to SoFi for sponsoring this portion of the video. Now, I mentioned that I actually opted for a variable interest rate student loan when I refinanced with SoFi, but whether a fixed versus variable rate loan suits you better will depend on several factors, including your risk tolerance, financial goals, and length of the loan. With a fixed rate, lenders are pricing in a premium. This is why variable rate loans tend to start at a lower annual percentage rate. One of the benefits of a fixed rate loan is that your payment amount is fixed throughout the life of the loan. If you want consistency and want to know exactly what the cost of your monthly payment will be throughout the life of a loan, a fixed rate loan might be worth considering. If you don't want to deal with the risk of the interest rate increasing on you, a fixed rate loan might work for you. In my personal situation, when I was having to answer the question of should I go with a fixed or variable rate student loan when I refinance, I took a look at my risk tolerance and my financial goals. My goal was to pay off my student loans in under 2 years. I was tackling them very aggressively. So with that relatively short timeline, I felt like the risk of the interest rate for the variable rate loan fluctuating was outweighed by the savings I would get. And as is generally the case, the variable interest rate that I was offered was lower than the fixed interest rate. So I was willing to take that risk in order to get the savings I knew I could get with the variable interest rate. I was also okay knowing that the minimum monthly payment might fluctuate because since I was tackling my loans aggressively and paying more than the minimum monthly payment anyways, I still had the set dollar amount in my budget that I was putting towards my student loans each month. Ultimately, whether a fixed or variable rate loan is best for you is going to depend on your personal situation and preferences, and like we talked about, your risk tolerance, financial goals, and length of the loan. One final tip, if your interest rate increases above your comfort zone, you may qualify to refinance it again into a fixed rate if that makes sense at the time. Now that you understand the difference between fixed versus variable rate, I'll see you next in this video where I reveal exactly how I paid off over $200,000 of student loans in under 2 years. See you there!